All right, so estimates, 2.9% headline. I know Jay Powell said 2.9% was fine for PCE. Is 2.9% okay for CPI, knowing that we have this Fed meeting coming up just less than a week, just about 6 days away? And if it comes in line or lower, what do you think that means for the market?
Well,
tough questions, right?
Yeah, a lot of questions. 2.9% is above the Fed's target. I mean, the CPI runs about a half a point above the consumer expenditure deflator, which is what the Fed targets, and that's the 2% target. So if you're at 2.9, it's about a half a point above what it should be. But it's really about the direction of travel. Inflation will continue to accelerate because of the higher tariffs and the immigration policy and the effect that's going to have on labor markets. So, you know, if you just looked at that alone, you'd say, oh, well, the Fed's not going to cut rates or may even raise rates. But obviously the economy is struggling. Job market is really now at a standstill. Job growth is flat at best. And I think that's going to win the day, obviously, and that's why we're going to get the rate cuts.
I want to go to my other question for you. I mean, I know you're not a market guest, but just what are your...
I can play one.
You can play one? Okay.
There
you play one on TV?
Yeah, I play
Did
one
you
on
stay
TV.
on a Holiday Inn Express last night?
Do people know that commercial?
I don't even know.
I love that commercial.
I remember that commercial.
I love the commercial.
But we better get down to business.
Yeah.
What do you think it means for the market if it comes in line or softer? Because everybody's already baking in the 25 basis point cut. Does that open the door for a 50 basis point cut that the markets would be happy about?
Yeah, I think if it comes in on the soft side of the 0.3, say it comes in at 0.2, it depends obviously on the details, but that would suggest maybe inflation isn't going to be the deal that people fear, like I fear, because of the higher tariffs. And I think market participants would think maybe that would be a reason why the Fed might go 50 basis points, price that in higher, and you might get a rally. But, you know, that's pretty intrepid affair trying to forecast what the market's going to do day by day. I don't know how it's going to react to a statistic.
You know, one other thing that I think could be interesting, at least, following CPI, is the idea that a Supreme Court ruling related to tariffs and the idea of refunds and the impact that could have on the bond market. We also know that CPI could have an impact on the bond market. Does the Fed actually pay attention to these bond yields? Are they paying attention to the fact that the bond yields are going lower?
Yeah, for sure. I think the bond market is a signal as to, you know, how investors are thinking about things and how it reflects their perceptions of what the Fed's going to do. So I think Fed officials pay very close attention to what's going on in the bond market.
Is there any scenario where we're looking at the decline in bond yields? Right now we're looking at the 2-year, 3.5, and the inflation comes in hot, and the Fed says, well, maybe we can't cut coming up less than a week from today?
I think that's a stretch, really, because the job numbers are so bad.
Okay.
I mean, you know, we're getting negative numbers now. And with revisions, when we're going to get more downward revisions at some point, you know, we could be in recession. It's a possibility. And I think the Federal Reserve desperately wants to avoid that kind of outcome. And, you know, obviously nobody wants a recession, but also in the context of Fed independence, you know, they really don't want to get blamed for, you know, going into a downturn, because that would impair their abilities, I think, going forward. So I think the bar is really high for them not to ease interest rates. And the bar is high for a 50 basis point cut, but, you know, there's a possibility we could get over that.
All right. JP Morgan came out with a note saying that there's 6 cuts priced in by the end of 2026.
Okay.
What's your view? I want to get your take on that. Is that a realistic scenario? We know about the weakness in the job market, but inflation, it does seem to be a bit more persistent than we previously thought.
I think that's reasonable. So, you know, you get right 4.25, 4.5 on the federal funds rate target. The equilibrium rate, that rate at which policies either supporting or restraining growth, is, say, 3. So you can do the arithmetic, you get around there. And, you know, it's possible if the economy is weaker and recession risk higher and concerns about Fed independence greater, that we get something lower than that, 2.5 to 3%. So that's very consistent with what market expectations at this point.